Happy Friday, everyone. It is Friday, the 6th of February, 2015, 8:01 a.m. Chicago time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinion, market data, and recommendations are subject to change without notice. Past performance is not indicative of future results. It's a mouthful. Couple of news items overnight. Europe's finance ministers are to hold an extraordinary meeting on February 11th on Greece in search of a lasting solution. So I would probably mark that on your calendar, February 11th. Might get some market moving news on that, the conclusion of that meeting. I'm not sure. Of course, this morning at 7:30 Central, we got January's change in non-farm payrolls, 257,000 versus 228 expected, caused a quick push up in the market. Change in private payrolls, 267,000 versus 222,000, also a blowout number. January unemployment rate is at 5.7% versus 5.6% expected. And then another beat here is January's average hourly earnings month on month is 0.5% versus 0.3% estimated. This is the largest rise in average hourly earnings since November of 2008. Year on year, 2.2% versus 1.9%. And then the S&P fair value for today has dropped down to negative 5.3 between the cash and the futures today. Other than that, looking ahead at the calendar today, we have 11:45 Central, 12:45 Eastern. We have Fed's Lockhart speaking on the U.S. economy in Florida. And then again at noon, 1 Eastern, we have the Baker Hughes rig count. The only reason I bring it up is because last week it was off by 90 and caused a very large move in crude. And then at 2 p.m. Central, 3 Eastern, we have December consumer credit expecting 15 billion. That's a low importance number. Let's look at the technical picture here. Yesterday, the market opened in range out of value. The primary hypothesis was for the market to open actually a little bit lower. However, we finished 15 minutes before the open, a little bit lower into value, and the expectation is for it to push into 2040, and chop around probably 2040 to 2037 is the expectation for it to find a base and then to walk itself back up and push into the 2055 weekly high, and then of course the 2060 would be the extended target. What it did instead is it opened as an open auction in range. It tested both sides. It could not get into the prior day's value. You can see here where it turns gray. That's the value high at 42. Could not quite get there, stopped at 43, and then it pushed out of the prior day's range. Recall that the prior day we sold off, and we were back at the scene of the crime as expected by the time the market reopened. So we broke that, and note that the entire day it did not breach and hold the mid. So it was a long side only trade yesterday, and I did expect the 60 to be tested. We stopped about 5 ticks short of that. Very quiet day, fairly decent volume, 1.08 with 15.75, almost 16 points in the range for the day session. Fairly in line with the traditional range. So the market's gone back to compressing, as we always have in rally mode. So ultimately, we did not end up achieving the key target, which was 2060. We stopped just short of it, and we closed in the upper on the upper end of the profile. Overnight, we had a pullback. We had a pullback to yesterday's point of control. It sat around sat around there for quite a bit of time, and then with the European Open, not much really. We see that in Euro stocks and in the DAX and the Bund that really was nothing was happening in Europe, and then of course once the non-farm payrolls come out, number comes out, it popped right through that 2060. And you can see here it was building an HVN here. A lot of volume went off at 2060 there, and it's holding prices higher. Creates a bit of a tricky situation here because the 2016 is now below us in the overnight session. We have not tagged it on the day session. So my primary hypothesis for today is going to be responsive, meaning the expectation is for the market to open. I expect the market to open and quickly pop higher, assuming it does not drop it does not drop back into yesterday's range. This is a big assumption now because we still have 22, 23 minutes to the open. I have to assume that it's not going to drift back down. But if it does not, we have a gap. The expectation is for the stock market to open and for a reactionary move to take place, pushing prices higher, but I expect responsive selling back into 2060 at least, and potentially down into a prior day's range as a primary hypothesis. I don't see the market easily pushing through here and continuing higher. I just don't, because of the volume involved. So you could see here these yellow circles here is volume. Let me extend that out. Oh, hang on, messed that up. All right, so hang on. Let's shift this back up. I double-clicked in the wrong spot. So what I want to do is look at, extend this out through yesterday's. So you could see here the volume that we're tangled up into. This was the point of control, the MC point of control for a long time, and this is the area we're trading now. The MCLVN is at 56.75, 56.50. We have a high volume node that was created there yesterday, trading that pretty well. It's also the overnight point of control, but I expect us to get tangled up in this high volume zone today. So this is where we're at. We're trading 61.75, 62, right in this high volume node. If the market starts to run away, and note, by the way, the overnight high is right on that composite low volume node, the MCLVN right here. Right here at 65.50 on the nose. And so what this market has done is in the overnight on the swoosh up of the non-farm payrolls went right into the MCLVN, the low volume node. And I want to remind you, with an auction, the market accepts prices, trades there. The market facilitates trade. That's the market's primary business, is to facilitate trade. The market's nothing more, and it has never been anything more for thousands of years than a place for price discovery. People bring their goods to market to sell or to buy them, and to discover what their goods are worth. Think of an antique fair, or think of a flea market. People don't know what their stuff is worth until they bring it down there and find out what buyers are looking to bid for it, what other sellers are looking to offer. And this is what we have, except we've sophisticated it with high frequency and algos and doing it electronically as opposed to face-to-face. But ultimately, the market moves from rejection areas to acceptance areas, to test rejection areas, to fall back, or to continue higher, depending on the economic conditions, which we cannot predict. So all we're looking for is, what does it do when it reaches a balance zone? This is why I say it's a chop zone. I expect a chop zone when the market's here. It's because these are fair prices. There's quite a bit that traded here, and the market's back at these prices. And then the low volume nodes are areas that where very little trading happened, or relatively less trading happened. And so we expect a test and a bounce, or a test and rejection through. We don't know what it's going to be until we get there. but it gives us some context as to what to expect. And what I expect here this morning is an OAOR open auction out of range. I expect it to try to go higher, and I expect it to fail, responsive back into the 56.50, 56 quarter area. And if it fails to hold that, if it holds the 56.50, 56 quarter area, then I expect it to rotate back up to 2060 and fight this for the balance of the day. If it cannot hold this 56.50 area, then you're looking at 53 and a potential test of the 51 again. So that's the primary hypothesis. The second hypothesis, or the secondary hypothesis, is something you can already guess, that it opens and it breaks higher as in a continuation range of the existing impulsive move that occurred on non-farm payrolls. But we still have an unauctioned zone in the day session, and I expect the market to respond to that by profit taking from the longs. The overnight inventory is long, so I expect that to balance on the open. Okay, real quick, Euro stocks, nothing, nada. No, nah, it's not moving. It's been stuck here since the ECB announcement and has not gone anywhere. 33.70 is still your key price, and it's still in balance. It's forming another HVN on the high side here, so it's creating energy above. It has taken out the prior high at 30 by a tick a couple days ago, and has fallen all the way back to the MC point of control. So the FESX, or the European markets, European equities, this is the equivalent of the S&P 500, except it's a lot cheaper to trade. The European market is basically in a holding pattern and just flying in circles, waiting for the next move by Greece or the ECB or whatever. It's got a fair amount of energy in it, but the trade has been the trade volume has been less than what we would consider to be the norm, and continues to be so. Crude oil, this thing's all over the place. So at this point, with crude oil, it's become somewhat irrational in its behavior. Just a couple of days ago, we talked about it falling back into balance, which was what was expected. Expected it down between 49 and 47, expecting it to bounce here, build a higher, a thicker balance zone, build up some energy for the next leg. And it's just been popping out, popping in, popping out, popping in, almost having a trend day down, trend day up, trend day down, trend day up. This is what we've been in since the balance day last week, or on Monday. So it's with crude oil right now, it's a little harder to predict. I expect that because we pushed up, and it is in balance, we pushed up yesterday. I think this 54 24 price is secure for the intermediate term. I think it's not likely to push this price higher, but we'll see. I expect to see a selling day today. I expect it back at $51. This morning on the pit open is already there, but on the trade that we start to have here on the open, I expect it to drop to 51, and I expect it to sit inside of yesterday's range. Not much to give you there as far as probabilities. This is a kind of a 50-50 thing. It's just swinging around. However, we have a pretty secure high here. We have a very strong pullback, the impulsive move. And the reason I think this is fairly secure is that this impulsive move had a pullback down to 47.95, which is too deep for the probabilities to threaten this 54 quarter in the short term. The pullback is more than 50%. So the probabilities are better that it would go into balance than to have a continuation push above 54 and a quarter. Again, all of that changes if somebody in Saudi Arabia says something or whatever. It's just a very, very news-driven product right now, and it's a very nervous trade for whoever's in there, so be cautious. I'll leave you with those thoughts. I want to remind you, as I always do on Friday, Don't go into a weekend with a hole in your pocket. It's better to take your licks today and stop with a daily loss limit than to continue to fight the market and create a big hole that you have to live with over the weekend and can't do anything about. It's very damaging to your emotional capital when it comes to Monday. You will not be able to trade the same way you already did. So be cautious. Pick your spots. Only trade when you see an edge, and an edge is something as simple as having an event that might create a probability for gain that is higher than the probability for loss. That's an edge, and you need to identify that. And hopefully, creating a plan and a contextual push into the market as it opens, or a contextual view into the market, is helping you kind of filter out the nonsense. Okay. Good luck, and I'll catch you on Monday. Take care.